Last week, I talked to you guys about budgeting inside of QuickBooks Enterprise, and today we're going to take it a step further, and we're going to talk about the forecasting feature. I kind of call it a phase 2. We talked about budgeting. Now we're going to talk about forecasting, kind of how those two relate with each other. So we're going to talk about what is forecasting, what's the difference between the financial budgets and the financial forecasting, why a company would need to create a forecast, and of course, as always, we're going to look at reporting so that we can have the details we need to make those decisions. Okay, so in my sample file, first, as I told you guys, let's talk about, what is forecasting? So the same as budgeting. It's the practice of estimating future revenues and expenses over a specific time period, often monthly, quarterly, or annually. This is going to allow companies to help predict cash flow, plan for growth or downturns, of course, help us set financial goals and benchmarks, and help compare projections with actual performances. Okay? So, what's the difference between a budget and a forecast? So, when you go to create either one, we're going to come into company. We're going to go down to planning and budgeting, and you can see that we've got both of them, to set up the budget or to set up the forecast. So kind of the biggest differences between the two. So when we talk about the budget, these are usually detailed financial plans, and they're created before the fiscal period begins. So a lot of times companies will start with their department heads in October of the current year to start creating that budget for the next fiscal year. Of course, the purpose of both of these is to set financial targets and spending limits. And this is going to allow us to have a benchmark for measuring the performance and assuring there's financial discipline. Okay, so a little bit different on the forecasting side. The forecast is a financial projection, but it's based on current or historical data, and it's often updated during the year. Where we see a budget, usually once it's approved, they should not be changed. A forecast is more like a moving document. It's going to change as the business changes. Okay, so a little bit different goal on this one is this helps us anticipate the changes and supports decision making when there's uncertainty. So you think of that budget, and we have said that as a company, this is going to be our goal or our focus. And if we're not hitting those goals, then we want to take it down and we want to start forecasting. What can we do? What changes can we make? Okay, so when you think of when to use them, as I said, creating them, a budget, we're going to create it at the end of the current fiscal year or the beginning of the next year. Forecasting is created and updated at any time during the current fiscal year. A budget is based on expected revenue, expected goals, and expenses, where that forecasting is based on actual data, trends, and assumptions. When it comes to flexibility, budgets should be fixed once approved. We should never change our budget numbers, where forecasting is flexible. So we're going to update as the conditions change in our business. Okay, so kind of thinking about those two, budget is set and it monitors the financial goals, where a forecast responds to changing conditions and adapts and changes and plans accordingly to those changes. So let's go ahead, as I'm going to show you guys just so you can see how they look the same and what the differences are. So last week we created our budget. You can see we've got everything. This is our active GL accounts, and we've got our month-by-month projections. Let's look at the forecast. I went ahead and created one, save some time here. So you can see it looks the same. Okay, so sometimes when we're thinking about creating that forecast, we're going to start it at our reporting. So under reports and under budget and forecast, we're going to look at budget versus actuals. Now, again, why we would create a forecast is if there's changes and it's causing us not to hit our goals that we have in our different buckets. And so we want to start planning and changing what can we do, what can we change, what goals do we think we can hit. So a lot of times when we're looking at creating our forecast, we're going to look at our actual data. How are we actually doing per month in these different buckets? So for example, in January, we budgeted in construction income that we're expecting to do $34,320. And as of the end of January, we're at 0. Okay, so we're under budget. So you can see here that we've got our budget numbers and we've got our actuals. Okay, so I'm going to do the exact same thing and flip it over to the forecast since this is what we're talking about. So we're going to go reports, we're going to go to budgets, and we're going to look at our forecast overview. I'm actually going to flip it to our budget, our forecast versus actual, so we can kind of talk about that. So of course, just looking at the report itself, let me kind of go over what the structure is. So of course, our header up here, this is our business entity name. We've got our title. It tells us what report we are running, and it tells us our time frame. So we have where we can customize and change our date range if we want. I'm of course leaving it for the full year because I want to show you guys all of our different pieces of it. We've got our account categories. So our revenue accounts, our direct cost, and our indirect cost over here. This is what we would expect that we would have transactions to support these accounts every month. Okay, we've got over here, this is our columns. So we have our forecast number. So what we're expecting to hit as a company based on those transactions. And then of course, we've got our actuals. So this is the real numbers, the actual transactions that we did and the revenue that we had during this reporting period. Coming over here, we've got our variances. So you've got 2 of them. You've got it in dollars and you've got it in percentages. So the dollars is going to calculate the difference between the actual and the budgeted amounts. The percentage is going to be the variance as a percentage to the budgeted amount. Okay. When you see differences here, so a positive variance is going to indicate under budget spending or over budget revenue. A negative variance is going to signify over budget spending or under budget revenue. And then you've got your totals here. So you have a total per, you could call it sections or headers. So total revenue, of course, is going to summarize all of our total income accounts, what those balances are. And of course, expenses is going to be the exact same thing. It's going to be the total of our expense accounts. And then if you come all the way down to the very bottom, we've got our net income. So this, of course, is going to be the difference between our total revenue and total cost. So now let's talk about how we would use this report. Okay, what's important about these reports when we talk about our budgets versus actuals and our forecast versus actuals? Okay, so what we're looking at is we want to identify those variances. We want to look for significant differences between our budget or our forecast number and our actual figures. What we're looking for is we want to try to pinpoint the areas that are needing attention. Where are we not performing what we expected as our goal? Okay, we also want to look at trends. So we want to analyze trends and we want to see if the variances are consistent over time, indicating that there is a potential issue or, of course, an opportunity if we are hitting higher than our goal. And then, of course, we got to make a decision. What are we going to do? And that's where that forecast comes in. So we're going to use our insights from our report to adjust our budgeted numbers with our forecast. We, of course, want to look at how we can control cost, how we can reallocate resources effectively if needed. Okay. Of course, if we're consistently failing our monthly numbers, then we need to take a look at what those goals are. Are they achievable? Do we need to be more strategic in our approach to identify what's going on? What is the root cause? And of course, implement something different. Implement corrective measures to get us to those goals. Okay? So when it comes to revenue, we have revenue shortfalls. We bring this guy all the way back up here. We talk about revenue shortfalls. We're, of course, going to look at actual and forecast revenue. And we need to ask ourselves questions. Is the problem due to underperforming of sales? Okay. If so, then we probably need to take it a step further, and we need to break it down by product line, by region, by client. We need to look at where those expectations are not being met. And there's other reports inside of QuickBooks to do that. For example, if we look at our product line and we think of, do we have good margins? We have a report under here and under sales, and we can look at sales by customer and item by summary. So let's look at that one, for example. I'm going to do it back with our sample file. Yeah, I'm going to do it for the year so we can see what it looks like. Huh? We don't have any data for 29. That's what I get for playing in a sample file. Okay, in this file, for example, it's a service-based sample file, but you can see that we've got the quantity that we sold in our different services broken down by our item structure that we have created. It gives us a quantity. It gives us an amount. If this was inventory, it would take it to the next level to say, what is your cost? So that way that you can see those gross margins between cost and sale. So this is a good report for when we're thinking about the underperforming of sales. Is it we need to up our prices because costs have gone up? We're seeing that a lot lately. We have to look at this. We cannot just say, well, it's going to get better. We have to break it down, and we have to pinpoint what's going wrong, and then we have to come up with a plan to make a change, get us back where we want to be. There's also things to think about. Is there any external factors? Market downturns. Is your business seasonality? Or is there competitive pressures that could be responsible for our shortfall in sales? So these are things that you're going to talk through when you think about building this forecast. What makes sense based on what's going on with those internal and external factors? What changes do we need to make? And this is where we can then start forecasting. Okay? When we think about our expenses and we're overspending, things that we need to look about and think about as categorizing is our payroll or labor cost, the operational expenses to run that business. Is it, maybe overhead is exceeding the budget? We need to look at what we're spending in overhead and see if there's anything that we can change. Also, we need to look at when it comes to those expenses, is it a one-time versus recurring cost? So you could have unexpected expenses that might not reoccur, or on the other side of that, you've got recurring overspending and we need to make a change. So we need to adjust our forecast to think about those reoccurring overspending. Okay. So of course we're going to adjust and we're going to create this forecast based on those insights. So kind of when I think about, I told you guys about like revisiting pricing, looking at those reports. Customer sales is another one. So let's look at that one. That's under the sales too. And we've got a sales by customer summary. And again, we can see what we did, and it's broken down by our customers. So we can see, did we expect to get a project move forward that we expected, or is it still out there? Sometimes I have clients that will use the income tracker. This is where we start working with clients to create those scorecards and those metrics. What is important to keep track of? What do we need to look at every week versus every month versus every quarter versus annually? And a lot of times when we think about the shortfalls of sales, it's what are we expecting to move forward in projects every week so that we can measure that and make sure we are on track. We're hitting that metric every single week. And if we're not, we're making adjustments. We're coming back to that drawing board, coming back to that forecasting, and we're making changes so that we can hit those benchmarks that we put in place. Okay, so some ideas to do that. Think about improving or changing our sales strategy. Revisit our pricing. Remember what I told you. If we are not profitable and we don't have enough margins, then we need to adjust our prices. We need to adjust it based on what the cost is today, not what it was last year. Maybe promotion. Maybe have a BOGO sale or customer outreach. Email blast sometimes will, help kind of push those sales over that benchmark that you're looking for, reminding customers what you have to offer. Okay. Upsell and cross-sell to existing clients. It's always easier to increase an average revenue per customer on your current customer base rather than starting fresh. Okay, at Fourlane, we like to have long-term clients. We build that relationship. We put lots of time and energy in building the relationships and building how we support our clients. We want to keep those going. We call those our key accounts. Those are the clients that, it's not they've come to us for one thing and we've helped them and they've moved on, but we want to keep the relationship going. We want to keep supporting them. We want to help them make these changes and come up with strategies to get them to hit their benchmarks, help them create scorecards for those weekly metrics to look for. That's what we do to support our clients. Okay, so another thing is looking at on the expense side. How can we cut non-essential cost? How can we delay? How can we reduce our spending in that area? Maybe one way is the cost of product that you're purchasing. So renegotiate vendor contracts. Maybe talk to other vendors, look for better rates or maybe volume discounts. When you purchase product, ask, do they give a discount if we purchase more? Okay, so of course, we always want to look at our internal processes and what we're doing. We want to streamline our processes. We want to automate tasks where we can. We want to reduce the waste, the energy we're spending on manual tasks. I always tell clients if we're using Excel to make decisions instead of our accounting file, we need to talk about that. We want to bring that data into our accounting file. Use our accounting file to make our business decisions. We shouldn't have to have an Excel document. We should be able to put the information in our accounting file. And if it's structured based on your industry, you can do that. Okay. So when it comes to looking at your forecast, how often should you do it? Well, it depends on how it's going. It could be weekly, it could be monthly. I would say the minimum is you should reforecast, adjust your budget, adjust your forecasted numbers based on the updated performance at least monthly or quarterly, because it's going to continue to change. Maybe we were able to come back in our construction income by those promotions that we did, by changing our costs, renegotiating vendor, so we can change and we can update our goal for our income. Okay. Also, when we're kind of strategizing about this, we need to create scenario plans. We need to think of what's the best case scenario. We need to think of what's the worst case scenario. And we need to, kind of talk through expected outcomes for each one so that we have a plan in place if worst case scenario happens. Of course, we want to celebrate if best case scenario happens. And of course, also, we want to communicate the changes across all the teams. So we want to make sure that every department head understands the revised targets and their team is focused on making those changes where needed. Okay. So also part of this, when we talk about the department heads, when we talk about forecasting and needing to forecast because we're not hitting budget, This is where we want to make sure that we assign our budget owners. Every department should have clear leadership responsibility to stay within our budget and or forecast. And then when we talked about the reviews, we want to have monthly reviews with those department heads. We want to review the variances. We want to create an action plan where we need to. Okay. So a lot of times we kind of send this report out, where we're looking at, these numbers. And sometimes it's the budget and the forecasting. You'll send them both out because you want to see, when we talk about that budget, we say this doesn't change. This is what, as a business, that we said we were going to do. And then if we haven't hit it, so we've created our forecast, well, we want to see, are we getting back in line with that budget? Okay. So when we think about that, forecasting or thinking about creating those, we think about where in the original budget assumptions, where were they too optimistic? Where were they misaligned with what reality is? And again, this budget versus actual is going to show you that. And then, of course, we want to look at trends. So why I have this to where I can show you guys a full year is because this is showing you your trends. This is showing you how you did in previous periods. That way you can make future budgets more realistic, or your future forecasting more realistic based on how you're actually doing. Okay, so last piece I'm going to share with you guys is red flags when we talk about what needs attention. Okay, so if we're consistently not hitting any of our budget numbers, that's a big red flag, urgent attention. Okay, so if we're consistently falling short on cash flow, that's a big red flag that needs attention. If we have a high debt to income ratio, we shouldn't have that. We need to ask ourselves, what's going on? Why are we overspending so much? If our gross margins are declining or we're not having customer retention, we need to stop and we need to meet as a leadership team and dig into the issues and the why and come up with solutions. Okay, sometimes it's we need to restructure our company, restructure our accounting file. We need to look at consulting with a financial expert such as Fourlane to help you get where you need to be. Okay, so kind of here's, I know we're kind of running out of time. I shared a lot of stuff with you guys, but kind of a management checklist. Let's just call it that. So kind of here's the things you need to be looking at so you can create a corrective action plan if you need to. Okay, so first, we're going to look at our budget versus actuals. And if we're not hitting those, we need to diagnose the problem. So we need to make sure that we are reviewing these every month to make sure that we are not losing sight of what our company has agreed to, what our goals are as a company. Then we need to look at the accounts with the largest negative variances, and those need to be our focus. From there, we need to then dig in to decide, is it a one-time event that's causing the issue, or is it a reoccurring issue? If it's reoccurring, then we have to create that forecast to make those adjustments. Okay, meet with your department heads, get insights from them, put that ownership on them to explain, to understand. Analyze your cash flow. Make sure that if we are having a shortfall on cash flow, we know why and we have a plan. Okay, that's another scorecard we create for clients is cash flow reporting. Yes, QuickBooks does have cash flow reporting, but I'm going to tell you guys, a lot of clients don't like it. I'll show it to you. And we've got our statement of cash flow and we have a cash flow forecast. But when you look at this report, you don't have any customization. This is the standard report that it's pulling its data from its GL accounts. And sometimes our clients want to pull from loans, line of credit, some different things that they want to see as part of their cash flow. They want to see their expenses broken down. So we create customized cash flow as part of their metric reporting that clients are looking at every week. So we can help you on that. Okay. So after we create that plan, we look at what's going on. We now need a corrective action. So we need to figure out if we are having issues in revenue. We need to increase our marketing. We need a sales outreach. Maybe we have a one-time discount, one-time promotion. We need to focus on how we can upsell or cross-sell to our existing customers. Maybe we need to work on a new customer group or a new business line. So think of ways that we can increase that revenue. On the expense side, freeze. No more travel. No more trade shows. No more events. If we need to freeze that spending for a while so we can get back where we need to be, then that's what we have to do. Reduce overtime. Review staffing needs. Do we have too many? Negotiate better terms with our vendors. Ask about the volume discounts. Okay? And then, of course, we're going to use our forecasting feature and we're going to reforecast and adjust our budgeted numbers for what is actually going on. And we want to project that over the next month, quarter, 6 months. And we want to, again, create scenarios, best case, worst case, when we're creating this forecast to make sure that we are able to hit these numbers. Okay? So I know I gave you guys a lot of information today. If you need help creating these reports, need help with scorecards, I need help with even how do I create a budget? Where's my starting point? How do I forecast? Please reach out. Fourlane would love to be part of helping your team, get you guys there. Again, we want to have good data in QuickBooks to help make decisions to grow our business. Thank you guys so much. I know we're right at time. I didn't have time for any questions today, so if you'll please just put those in the chat. We will get them answered for you. And as always, thank you guys so much for joining me today. I really appreciate it.